Special journals. Why do we use special journals? What special journals are there? How do we make the decision on what journal a transaction should go through? And then let's look at this with an example. So that's where we're headed over the next few minutes. So we have special journals basically because they're very efficient. If you really want to understand how this efficiency arises, how it comes about, see the video Special Journals while they are needed. What special journals do we have? Well, we can have a special journal for anything that is likely to make us more efficient. The real starting point and the focus we'll have here are the cash receipts special journal, the cash payment special journal, the sales journal, and the purchases journal. So let's start off by looking at cash transactions, and cash transactions will go in what is often referred to as the cash book. I'm sure many of you have heard of the term the cash book, and this is a combination of the cash receipts journal and the cash payments journal. And so when we're talking about cash, what we're really talking about is any money that goes through your bank account. Not so much about notes and coins, but about what goes through your bank account. So if you put a deposit in, if you write a check, if you have some type of electronic funds transfer, bank fees, anything that appears on your bank statement should go in your cash book, either if it's a deposit in the cash receipts journal, and if it's a withdrawal in the cash payments journal. So that's cash transactions. Let's now look at credit transactions. So we have the sales journal, and in some ways you might think of this as the credit sales journal because it records all sales that you make on credit. It is important to bear in mind that any transaction that is recorded here will also need a corresponding entry in the accounts receivable subsidiary ledger. So what are we saying? You make a credit sale for $20. At the same time, you'll have an account receivable increase of $20 because now someone owes you $20 because you sold them something on credit. Similarly with the purchases journal, or how you might think of it, the credit purchases journal. This records all the transactions that you make on credit. Any transaction that is recorded here will also need a corresponding entry in the accounts payable subsidiary ledger, sometimes referred to as the creditors ledger, whereas the accounts receivable subsidiary ledger is sometimes referred to as the debtors ledger. What journal do you use? The simple test is this. Well, I guess you say there's 4 simple tests. The first one, you ask yourself the question, does this transaction involve the receipt of cash? And if the answer to that is yes, then it goes in the cash receipts journal. Does the transaction involve the payment of cash? If yes, then the transaction goes in the cash payments journal. If you still no to both of these, the question is, does the transaction involve a sale on credit? And if the answer to this, it will go in your sales journal and a corresponding entry in the accounts receivable subsidiary ledger. Fourthly, does the transaction involve a purchase on credit? And if your answer here is yes, the purchases journal is the journal you'll use, and you'll do an entry in the accounts payable subsidiary ledger. If we've got none of the above, then the entry goes into the general journal. So now let's look at this with some example. Now let's look at the use of a special journal in action. So here's a list of transactions for a month, and let's have a look at the first transaction. The first transaction says we're going to sell inventory on credit to W. Shorten for $100,000. The invoice number is 52 and the terms are 210 net 30. So terms of 210 net 30 means a 2% discount is available if paid within 10 days. And if you don't take up the discount, you're expected to pay the amount within 30 days. So if we sell inventory on credit, we go through the tests we had before. Does this involve cash going in the bank, this transaction? Well, not at this stage, so no. Does it involve cash going out of the bank? Not this transaction, no. Does it involve a sale on credit? Sell inventory on credit? Yes, it involves a sale on credit, so that goes into the sales journal. So if we go to the special journals and the sales journal and we look at the transaction, so the date, let's say is the 1st of the month, the account debited, actually that's the 1st, let's say it is May, the account debited is W shorten, the invoice number was 52. Here we have a posting reference, which we'll come back to that later. Then we're making a sale. And so there's two sides to this transaction. There's a debit to the account receivable and a credit to the sales. And the amount was for, let's have a look, to accounts receivable and a credit to sales of $100,000. Then, as well as that, and in this case we're using the perpetual inventory system, so when we record the sales we need to record the change to inventory and the corresponding cost of goods sold. So how do we work out what that is? Well, in this simple case we'll go back to helpful information and we'll see the gross profit margin is 60%. Therefore our cost of sales is 40%. How do we know that? Sales less gross profit equals cost of sales. So here, transaction, $100,000. So the cost of goods sold here, the cost of sales is going to be 40%, 40,000. So what does this effectively mean? We're bringing into account 4 journal entries with this. The same as if we'd gone to the general journal entry, we would have needed to go debit accounts receivable, credit sales $100,000. That's 2 journal entries for one journal, and then we'd have another journal which was debit cost of goods sold 40,000, credit inventory 40,000. Now let's have a look at another transaction. Sell inventory on credit to ABERC for 20,000, invoice number 53. So the next one would be May 1. ABERC was ABERC number 53, $20,000, and then 40% of 20,000 is 8,000. So what have we brought to account here? We've brought to account the sale of 20,000, and therefore the corresponding increase in accounts receivable of 20,000. And then because we actually sold something, we need to bring to account what that cost us, and the cost of goods sold was $8,000. So we record the cost of goods sold of 8,000, and correspondingly that means our inventory fell by 8,000. Now, there's some other things you'll remember. If we bring to account a credit sale, therefore we must also make an adjustment to the accounts receivable subsidiary ledger. So we're here, W shorten, we've made a sale of $10,000, of $100,000. So we go W shorten, it's down here. I'll leave the first line blank because an earlier step might have been to go in and put the opening balance. So May 1, explanation, well, we'll leave the explanation, we don't really need anything there at this stage. The reference is the sales journal. And I'll just go to helpful information here. Naming conventions for posting references. So special journal, the naming convention is S1. So in the subsidiary ledger, the reference is S1 because that's the journal we can track it back to. It was debit, $100,000, no credit, and then depending on what the opening balance was, then we'd have to put in the new closing balance, and that will be a debit balance. Now, to signify that we've done that, we come back to the special journal and we put a T in this column. Now, why do we put a T in the column? Well, prior computers, what would have happened is once this entry was entered in the subsidiary ledger, we would have put a tick to indicate that we've made the entry in the subsidiary ledger. And the tick has been translated to a T as we move into the computer age. A Burke, we can see, has not been done. Let's have a look at a different type of transaction. Here on the 15th, and we do all of these in order, but I'm just giving you a sense of how they'll go. Purchased inventory on credit from E entity for $20,000. So we go, if this is a purchase on credit, this will be the purchaser's journal. So purchaser's journal, date 15th, E entity, terms 210 net 30. Reference, well, we haven't posted that yet. Debit inventory, credit accounts receivable, that's the transaction we're going to do. So $20,000. So we put in there $20,000. And from there, we need to go to the subsidiary ledger, the entity. So the subsidiary ledger of accounts payable, we go down, find E entity on the 15th, and bear in mind there could have been some transactions before this. P1, and that is a credit balance of 20,000, so we owe E entity an extra 20,000, and we need to update the balance there. To indicate that we've done this transaction, we'd come back and put in the posting reference, come back and put in the posting reference as a T. Now, some things you will notice later on, and I'll do one example of the cash receipts journal. When we post these to the ledger, which is a step that comes after this, we add up all the transactions for the month and we just do one posting. Whereas in the general ledger, every transaction you would post individually. But here, we add all the transactions up, we put a total in there, and then to signify it's been posted, what do? Well, here we put a T. For the general ledger, we write in the account number. So if you see cost of goods sold and inventory, we've already started this one. We can see we put in 500 because there's two entries. That indicates we've posted a cost of goods sold. And now we do slash, and you need to go to inventory, general ledger. Actually, I haven't put them in here yet, so we need to go general ledger inventory. Would be, we see inventory, merchandise inventory, 120. So your entry in here would be 500, 120, but you only enter that after you've actually posted those items to the general ledger. Might just have to see if I can do one more entry. So receive cash payment for cash sales for $24,000. So on the 19th, account credited, cash sales, so the bank, check the amount, 24,000, 24,000 will be debit to the bank account because that increases by 24,000. Then we'll make a credit of 24,000 to sales. So this is similar to these items up here, except we had the debit and the credit both go in the one column. Down here in the cash receipts journal, the debits and the credits go in different columns. And why? Is because there's so many different options for the credit. Up here, it was pretty straightforward. It just deals with credit sales. So you'll have a debit to accounts receivable and therefore a credit to sales. Whereas here, anything you purchase will be a debit. Any cash you receive will be a debit to cash at bank, but you could receive it for a number of things. And anything you purchase will be a credit to cash at bank, but it could be a credit for a number of things. Well, there's your starting point for the special journals.
Transactions.